welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Well, you would have been hearing the headlines and they've been coming for a while. All-time highs as far as gold prices go here in India. And we are not too far away, even if you look at international prices. So is all that glitters really gold? Well, if you simply go by the way the precious yellow metal has returned, of course, over the last couple of years, you would say perhaps yes. A huge rally has come through. There is a lot of uncertainty out there, and the question is on asset allocation. Should you be removing some money away from equities, adding more gold to your portfolio? Is it too late, or should you still do that? These are exactly the kind of questions that we are going to put to our guests, and then also tell you what are the easiest ways in which you can financially invest in the yellow metal. My guests on the show are Aashish Shankar of Motilal Oswal Private Wealth Management and Gaurav Rastogi, founder and CEO of Kuvera.in. Gentlemen, thanks very much for joining in. What a ride, absolutely. And I have to start with you, Ashish. I don't have that clip immediately on me, but if I could, I'd go back to the Diwali special edition of Money, 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 when you said that one should increase allocation to gold to 15% of the portfolio. I almost fell off my chair, but then let's see what's happened over the last several months. Your first thoughts?
Absolutely, Surabhi. I must congratulate you. I think your show was the first to give a bullish call on gold to all the viewers. I hope they benefited. Since then, gold is up almost 15-20%, and we know what's happened to some of the other asset classes. Equity has fallen, and there have been issues on the credit side as well. So it's been a fantastic run, and we continue to be positive on gold, albeit not as bullish as we were, during Diwali, because it's had a good run. So one has to be careful why one is adding a gold exposure at this point in time. If you're adding it for diversification, definitely makes a lot of sense, and I'm sure we'll talk more about it, during the course of the show.
Absolutely, we will. Gaurav, thanks for joining the conversation as well. Now, for those of you who don't know, Kuvera, of course, offers not just mutual funds, but also something called digital gold on its platforms. Actually, even Motilal Oswal offers us that. A lot of agencies, including Paytm, etc., are all letting us buy gold digitally. What's that all about? We come to that in a moment. But Gaurav, again, first thoughts. This is such a time. If one has an additional 100 rupees of cash to spare, should it go to equities, or should you actually put it in gold?
Yeah. So this is a version of the classic market timing question. The gold that you bought over the multiple years, say you had a 10% allocation to gold, or as Ashish says, a 15% allocation to gold. The gold that you bought through multiple years was for these months. That's a very different statement than saying that if you had 100 rupees today, you should buy 100 rupees of gold and don't buy any equity. So the whole idea of asset allocation and the whole idea that it will work in the long run is that you stick to it. So for example, if you were, 80 equities, 20 gold, or more likely 60 equities, 20 bonds and 20 gold, or something like that of an investor, you should continue doing that. In fact, all good asset allocation models right now will actually tell you to take some of your gains from gold and reinvest it in equities. The whole the feature of asset allocation, the feature of rebalancing part of the asset allocation, where you keep on going back to your original asset allocation, is that you sell the asset that has done well recently and you buy the asset that has done poorly recently. So in a way, it's a reversion to mean trade. So yeah, if you have 100 rupees today and you have historically followed a certain asset allocation, please stick to that. I don't think timing wise, very easy to say whether gold is going to have another huge rally, or it's going to plateau, or is it going to fall.
Okay, I just want to pull up those graphics once again. Asset allocation, that's what we're talking about, right? So let's just take a look at what different asset classes have done in the last 1 year and 3 years. Now, 1 year has been very topsy-turvy, and we know that. So if you're looking at gold, imagine 37% is the return this year. The last time gold did something like this was way back in 2012. The Nifty 500, it's down 17%. It's not been a great year for equities. We know that. If you're looking at the CRISIL Composite Bond Index, which is generally giving us a sense of how the fixed income market has done, then that's showing you some gains as well. And if you're looking at the liquid index, which is basically liquid funds, then that's showing you a gain of about 6-7%. So that's just at a glance what different asset classes have done right now. So Ashish, now here's the thing. Let's take the example of a medium risk investor. And I'm asking you the same question. If someone's lucky enough, they still have income flow, they haven't lost their job, and they have some money to deploy, break up that 100 rupees. Where all should you be investing it, and how much in gold?
Right. So a medium risk investor typically should have a balanced portfolio. In a balanced portfolio, what we recommend is you should typically have about 50% exposure to equities. You should have 25% exposure to debt, and the remaining 25 you could split it between gold and cash. So you can either go 25 in gold, or you could do 15 in gold and 10 in cash. So that leaves you some liquidity for rebalancing. Now, the beauty of this portfolio, or any portfolio which is diversified across these three asset classes, is it smoothens the journey of investments. So typically in a year where equity is doing extremely well, some of the other asset classes like gold typically tend to underperform, so does debt. But in years where equity goes through a rough time, especially in years like 2020 or 2008, gold tends to do extremely well, and it protects the overall value of the portfolio. So a portfolio which is split across these four asset classes in the proportion 50, 25, 15 and 10 should bode very well for a balanced investor, Surabhi.
Okay, so that's what you're recommending. So I just want to take up one of the Twitter queries that we've got, Ashish, and I want to get your thoughts in on it, because we have Mr. Babu, I think, who is saying that he's 30 years old. And he says he was primarily investing in equity mutual funds and shares, but now looking at the uncertainty in the capital market and the financial market, he's saying, can I allocate 50% of my current portfolio towards gold? So it just tells us how people are disenchanted with equities, right? The last 3-4 years have been pretty difficult if you're looking at whether the direct route or even mutual funds. So what would you say to someone like this, Ashish?
Yes, I mean, like you rightly said, this tells us the amount of risk aversion that is there in the market, and also it tells you the amount of anxiety that people have in their minds. But definitely it would be a mistake to go and allocate 50% of the portfolio to gold at this point in time if you've been doing SIPs in equity funds. I would say that you must allocate maybe 10 or 15% to gold, but the reason has to be very, very clear. The reason cannot be that gold is going to do extremely well from here on and give the same returns that it has delivered in the last 2 years. You have to allocate to gold so that next time we have this kind of volatility, your portfolio is protected, or from a risk point of view, you get a much better feel of the journey. But definitely would not recommend taking out 50% and of the portfolio from equity, that too, which is actually down right now, and allocating to gold. And he's 30 years old, so I presume he's got a long time before he retires. So given that time horizon, equities should definitely outperform.
Oh yes, absolutely. And that's why we're putting out those graphics for you as well, that if you look at different years, I mean, this year has been a bumper year, 37% up, but there are years where gold is absolutely flat or up just 3 to 4%. The CAGR returns perhaps are a better way of looking at it. So we'll put up that slide as well. 3-year CAGR, the compounded annual growth rate, if you're looking at a 3-year bucket, if you were invested in gold for 3 years, then it's 11.5%. 5-year bucket is about 7.5%. And then there is 10 years and 15 years. So it's an idea of how much it can do to the portfolio. Okay, so Gaurav, let me come to you now. Now that we've established that 10 to 15% in the portfolio is still a good call, the question is how to invest. Now tell us a little more about this digital gold business, because it seems so convenient. You can go on your mobile phone, you can buy gold for as less as 100 rupees. And I believe it also allows you to take physical delivery. If at some point I want the physical gold, I can do that. So who regulates it and how does it work?
So it works on a very simple principle, right? So some of the issues with owning physical gold is security, and also it's the making charges that your jeweler charges you if you take delivery of gold, right? So what digital gold does, it basically says that let's look at gold as an asset class and not as jewelry and not as something that we think we are going to consume later in a wedding or in a birthday or all the different occasions where gifting gold has been culturally very important in India. So digital gold is basically one level of abstraction. It's actually backed 1:1 by physical gold, but the physical gold is kept in a vault. So all the economies of scale that accrue to the investor. You don't have to worry about safing. You don't have to worry about making charges. You don't have to worry about delivery. So it becomes a digital contract, but actually the underlying is physical gold. So that's what, simply put, digital gold is, and that's what allows you to kind of buy it and sell it in small denominations. You can buy it, actually, technically you can buy it as low as rupee 1. You can sell it whenever you need liquidity, and it just takes out some of those frictions of owning physical gold, but it is actually based on physical gold, so there is no leverage there.
Okay, well, that's what it is. Now the question is, how do you invest? Our viewers are asking lots of questions. There are sovereign gold bonds, there are gold ETFs, there are gold funds, and there is digital gold. Which is the most efficient way of buying the yellow metal? We discuss that after a break. Welcome back. You're with us on Money, 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 and this week we are talking about the glitter and the sparkle of gold prices hitting fresh all-time here in India, and people wondering if it's too late to add it to your portfolio. Our experts say not really. You can still go up to maybe 10 to 15% looking at the environment around. So I want to now quickly come to some questions that we're getting, some Twitter queries on how to invest in gold. There's a query that's coming from Jay Sean. And Jay Sean is asking, what is better to invest in the current scenario? What's the safest option? Gold ETFs or sovereign gold bonds? And he's asking, do gold ETFs pay a dividend as well? Okay, interesting questions. So Ashish, let me come to you for a comparative. I think people really want to know, in terms of tax implication and cost, what is better? Gold bonds, sovereign gold bonds also pay a 2.5% interest. But is that good enough reason to be investing in them?
Right. So just to do a quick comparison between a gold ETF and sovereign gold bond fund, a sovereign gold bond fund is locked in for 8 years. Of course, you can sell it in the secondary market, but if you sell it in the secondary market, then the tax efficiencies don't accrue to you. So for example, if you buy a sovereign gold bond fund today and keep it for 8 years, there is no tax on the gains. There is an interest which is paid out in the interim of 2.5%. The interest is fully taxable, but it's still good to have some income coming, because if you just buy the yellow metal and keep it in your house, it's not accruing anything. As opposed to that, the ETF gives you participation in the gold prices, because against those units, the fund buys gold. The taxation is like a debt fund. So after 3 years, it becomes longer term, and it also gives you indexation benefits. Just to answer his query, no, the gold ETFs don't give dividends. The advantage of a gold ETF over a sovereign gold bond fund is liquidity. You can sell it on the exchange anytime you want. And if you do not want the exchange liquidity risk, then there are gold funds where you can redeem the money from the mutual fund itself. So I would say that the answer is not one or the other. You could do a combination. I mean, for part of your portfolio, let's say 50% of the portfolio, which is a strategic asset allocation to gold, you could buy the sovereign gold bond fund and it stays in your portfolio for 8 years. You get income on it, and you also get the tax benefit if you stay invested for that period. And 50% of the portfolio, you can buy the ETF. So in case, let's say, the gold prices rise sharply, and there is an opportunity to rebalance from gold to equities or to fixed income, the ETF or the fund can be easily sold. So a combination of both these will work extremely well for investors. For high net worth investors, they need to keep in mind that there is a limit to how much you can buy into the sovereign gold bond fund. It's a 4 kg limit per financial year. But for most investors, it's a large amount, so it doesn't matter. So I think the idea is, the best is a combination. Maybe 50 to 70% you could do sovereign gold bond fund. The remaining liquid part of your portfolio, you could buy digital gold or the gold ETF.
Look at that. You have to diversify within an asset class as well, in terms of how you're going to own it and hold it. Okay, so let me come to you on these thoughts as well, Gaurav. Let's compare digital gold and a gold ETF. The bond is different, as Ashish just explained to us. Now, what are the pros and cons? Why should I do digital gold vis-a-vis, a gold ETF?
See, the construct is very similar in digital gold and gold ETF or gold mutual funds. All of it is backed 1:1 with actual physical gold. In one case, it's done by a gold trading company. There are a couple of them in India. In one of the cases, it's done by a mutual fund. There is good oversight in both cases. So the construct is very similar. The difference comes down to mostly cost, right? So when you buy digital gold, you have to pay a 3% GST, goods and services tax on top of it. When you buy it in ETF or mutual fund form, you don't pay the GST, but then you have to pay an expense ratio which accrues every year. So what happens is that the break-even comes somewhere between when does that expense cost for you overtakes that 3% GST that you're paying. But other than that, in terms of what value they provide you, both instruments are very, very similar. You'll buy digital gold, there will be a bit of a spread. When you buy a mutual fund or you buy a gold ETF, you don't see the bid offer spread yourself, but the mutual fund, when they buy gold in the open market, or the ETF, when they buy gold in the open market, they will still pay the same bid offer spread. So the difference literally comes down to, if you want to own gold for a long duration of time, you do still want to have the option of having liquidity, then you don't want to be paying anywhere from 30 to 50 basis points of expense ratios every year. But if you have a very short-term view and you think, you know what, let me make a quick call, 3 months down the line, I reassess it, then there is no point paying that 3% GST either.
Okay. So coming down to final thoughts now, Ashish, I think a lot of people will also hesitate right now because you're sitting close to all-time highs. And so one will wonder if I should, invest today, wait for a correction, will it even come? So how do you approach gold buying? Should you stagger it out like how you stagger out your mutual fund investments?
Yeah, so that's an interesting question. Of course, gold has done extremely well. Like you mentioned, last year it was up 21% in rupee terms. This year we're already seeing gold is up 20%. The best year for gold was 31%. This was 91 when we did the liberalization, and 2008 when we had the global financial crisis. So one should lower their expectations from gold going forward. The way I will do it, Surabhi, is if somebody doesn't have any gold in the portfolio, at least you should get to that 5 or 10% mark. And for the remaining part of the gold, you could probably do an SIP through an ETF or a mutual fund, or probably like Gaurav said, you could buy digital gold gradually every month and build the remaining 5% allocation. If you're already at 10 or 15, I don't think you should be adding to gold at this point in time. If at all there is an opportunity, you could probably look at rebalancing out to equities, because equities is relatively much cheaper. So it really depends on what is the final allocation you want to reach in your portfolio and what is the allocation you already have. So for incremental allocation, I would advise a staggered approach from here on. But if you have no gold in your financial portfolio, then first get to that 5 or 10% mark right away, and then add the rest gradually. So that's the approach I will take. Yeah.
Okay. All right. So basically, where you go depends on where you are, how much you already have. So as we are coming down to final thoughts, gentlemen, I mean, this is all about, financial goal, responsible decision making. I'm wondering, are you guys buying your better halves any gold? I mean, would you consider that some form of, mental, emotional and financial investment as well? On a lighter note, Gaurav, as we wind down.
No, sure. It's a very interesting question, because I think most of the gold that is sold in India is for jewelry purposes. Like I said, eventually it's used in marriages or in childbirth and birthdays and all. My mother is quite a gold. She likes gold jewelry. My wife actually doesn't like gold jewelry, so I think I won't be getting any brownie points if I bought her any. So that in that case, I'm kind of quite safe not buying a gold jewelry in that.
So you're sorted,
I'm sorted, yeah. So I don't have to face this.
So your mother likes it, but wife doesn't. You're sorted that way. So you'll stick to financial You'll stick to
Yeah.
financial gold. Okay, got that. Well, gentlemen, it's been an interesting and fruitful conversation. Thank you very much for joining in and also taking the viewer queries. Of course, we hope this has been helpful to you. We'll keep coming back with more ideas on personal finance. Right now, it's a wrap from the entire team.